The recent drop in sterling dollar has taken it out of the bottom of the recent range of 128.80 to 134, down to a 126 handle. The big question is where now and how do we trade it? Well, Ron William joins us now from RW Advisory. Ron, welcome.
Hi, happy greetings and good to be here again.
Thanks. Look, we got to follow up on the previous conversations we've had about what's been happening to cable, and you brought along some charts indicating that the trajectory looks like it's a sort of continuation pattern from when we went into this box, and you're projecting it to go lower.
Yes, well, we've been within this range, as most people know, for around about 3 months now. So it has looked a little bit boring, a lot of low volatility. But as I always tell people, not a time to fall asleep. It is a time when you know that there is a big breakout about to happen. There's always an action followed by a reaction in the market. Now, what's interesting is there might be a little bit of déjà vu if we see the chart, our opening chart. Yeah. Déjà vu to what happened on in and around the June 24th Brexit vote. Now, back then we had a two-way volatility move, a false move up, where we had a move of up roughly around 7% from the Remain camp, and then that was then followed by a surprise and very strong 12% downside move once the Brexit vote came out. Now this time around it is different in terms of the event, but the pattern is rhyming somewhat, and the way I've looked at it is think of it as the soft Brexit versus a hard Brexit outcome. And what we have had is, you know, people kind of thinking the storm is over and everything's now calm again, trading the market up. Also, we had moved too far down too soon, so the market became a little bit oversold. But in the end, it has resolved on the downside. And what's interesting is that breakdown did actually coincide with Prime Minister May's hard Brexit speech about early next year being the time that she may or may not execute Article 50. So we are now breaking lower.
Okay, so where do we go from this point here? You've drawn a probability distribution here on the left-hand side, the blue shaded area here. Explain where that fits in, because you've got a figure there of 132.30. Here we are now below 130. Explain the pattern you're expecting to develop.
Well, yes, technically, the momentum indicators are saying that we are oversold in the very near to short term. And you can see there just on the RSI indicator us dipping into the 30 area. That suggests that we're likely to get a limited oversold bounce into 132.30, which is the value area of that probability distribution, a tool that I use. And as a maximum retracement, maybe up to 135.35, but I think that is less likely. What is more probable is up to the pivot point of a 132.30, ease the pressure from that oversold condition, and then back into a new low breakout. And remember, this is the 30-plus year low that all of us are now looking at.
Okay, so let's look at the detail here. Are you suggesting then, from where we are at the moment, that the trade is long sterling dollar at the moment? Is that what you're suggesting?
I would actually suggest to fade any bounce from oversold conditions, i.e. to look for selling opportunities either now or into this limited bounce that we have from oversold conditions.
Okay, so the ultimate trade obviously is to go short, so you would just look for a little uptick before taking a short position.
Yes, and actually what I have been saying to most people is instead of calling this the triangle pattern, call it the Bermuda triangle pattern, because trade at your own peril. It leads to a lot of two-way volatility, and it's very difficult to actually trade successfully in these sideways patterns. Much better to trade the resolution of the pattern, particularly in line with the prior trend, which has been down.
Yeah. Let's look at the second chart, because you mentioned the rhyming of chart patterns quite often, and you've got some arrows here where you are now sort of projecting your thoughts on the downside. Explain what's going on here.
Well, this is Technical Analysis 101, where we use historical price and time patterns to project potential future movements in the rhyming fashion that we both alluded to. And this 3-month pattern is yielding a price objective of 121. For most other people, they might decide to use a range of 121 to 120, a big round psychological number on cable. But either way, this is a minimum price objective. Now, in previous interviews that we've discussed, actually a bigger move than that, and I can talk about that in the next charts, but as a minimum price objective based upon historical range of this pattern, it is suggesting 121, maybe 120 for those looking for a psychological handle.
Okay, and of course that arrow replicates the arrow that you've got there that was part of the soft Brexit move that we saw initially.
Yes.
Let's move on to the next chart, because I think this illustrates more of the downside. You've got a bit more on here. We've gone back as well to the probability distribution, but you've got here on the far right-hand corner the potential lows of 115.
Yes, well, ultimately that's the extended target which the technical setup, the big picture technical setup is suggesting. And I'll probably take a step back here to past discussions we've had, where the key point was that there was a perfect storm in terms of price and time technical signals suggesting that the market was going to crack lower even before Brexit became a reality. And that was suggested here by this historical 30-year support. So we talk about the new low breakout, historic lows, but very rarely do we get to look at that historical picture. And what that suggests is this 30-year support did break. It was at risk of breaking, and it was at risk of breaking at a key timing juncture, this 8-year cycle, which has worked pretty well over the last 30 years on cable. And so that showed a confluence of price and time appearing at the same time with mounting event risk. Now, all of that suggested asymmetric risk ahead of the Brexit, and certainly continues to into this unravelling of what Brexit actually will look like. And that suggests further downside, but further downside with a bottoming phase into the end of this year, early next year.
Your last chart, you overlay average price swings. How does this work?
Yes, well, this is very important to see how historical patterns have fared on average over the last 30 years. And it shows that each of the largest price swings on cable have yielded an average drawdown risk of around 21%. And so I've measured this latest downswing since the Brexit move of June 24th. And we've already seen about 16%, but we still have the remaining amount to cover. That is what equals the target of 115. So it's a mixture of the minimum price objective at 121, 120 into an extended and more likely target at 115 based upon the historical price swings on cable.
Okay, so that takes us down to the 115 level. That's then let's talk about exactly what happens at that point. Is that that's the point at which all of the shorts have been squeezed out of the market and no one's there in, and it then bounces back strongly, does it? Or does it stay at that 115 level for some time?
Well, history teaches us that market bottoms take time, particularly when we have sharp shock types of moves, and usually they're preceded by several false swings up and down. We've already seen that in this 3-month range. I think we see that again once we hit 121, 120, and thereafter 115. But I think in that second and final stage, that will likely be the bottom. But that will still need to take some time to actually develop. And as you say, for all the sellers in the market to actually be squeezed out in order to create that price vacuum which creates the reversal up.
And in terms of timing, you're expecting this final leg to develop later this year and early 2017?
Yes, that's what the cycles suggest. These long-term 8-year cycles actually tie into end of this year, early next year. It's important with such long-term cycles to have a little bit of variance on the deviations, and we'll maybe start to see the political and economic rhetoric tie in with the market. So it is important to look at that as a sentiment gauge as we start to create that bottom.
Yeah, coinciding doubtless obviously ultimately with the negotiations for full Brexit.
Yes, exactly.
Okay. Ron, thanks so much indeed there for joining us. Ron William joining us there from RW Advisory, taking a look at the potential bottom in the current cycle for sterling dollar.